I'm video guy today. I'm the video man.
Dude, I'm video guy. I did the podcast with Perlman and Lindsay today too.
Oh, did you? Look at you.
And I'm on Pat's show. Hey guys, JC Peretz here, founder of AllStarCharts.com. Welcome back to Pardon the Price Action. I am joined, as always, by my main man, Steve Straza. Let's get right into it. One of the biggest themes in today's markets are these base breakouts. The list of them continues to grow. Which ones have your attention this week?
I think it's easy, right? We're moving in sequence, just as you would expect. We talked about the base breakouts in large cap tech, XLK, large cap communications, XLC. Now we want to look beneath the surface to those subsector indexes in the growth and tech space and see, are we getting confirmation there? And we very much are, and in a big way, right? So whether that's semiconductors breaking out of a base that looks strikingly similar to tech, or software. Today we have IGV, large cap software, making new highs, getting back above those August highs. That's the Dow Jones US Software Index you're showing there. But we are seeing that strength now spread to the subsector indexes. And I think that's a really big deal.
No question. I mean, just look. Here, what's the common theme? The common theme is that these all look the same, right? You know, one after the other. You have these massive bases. Here's the IPO index, which has been just a great poster child for this particular down cycle. The IPO index peaked in early 2021, along with like ARK and Chinese internet and biotechnology. It was kind of part of that same theme. Everyone had a SPAC. All of that peaked in early 2021. And you're seeing these bases one after the other: cloud computing, social media. Like, it's all in that, like, you know, post-COVID sort of theme. And now we're just seeing monster breakouts in technology on a relative basis, just, you know, base after base. So are we going to see that in small caps as well? Is that the base building process here? That's a big one that I'm looking for. All right. Next topic.
Big cap tech has undoubtedly done a lot of the heavy lifting this year. We just talked about it. What kind of action are we seeing from more speculative growth stocks?
Well, I mean, I hate to kind of reiterate the last segment, but I mean, that's really what it is, right? Just continued resiliency. I mean, look at Micron, look at, you're saying like going down the cap scale, like it's not just a mega cap tech. Is that kind of like what you're saying? Like the theme, people keep telling you that it's only 5 stocks going up, but there's a lot of evidence that it's not that.
Yeah, we want to see these ARK indexes work, right? Is there a better barometer for speculative growth? We got 4 straight up weeks for ARK. You know, is it enough?
Is it enough to get 4 straight up weeks in ARK? I think for me, it's the underperformance out of ARK that we're seeing compared to some of these others. Like, this base in ARK looks very familiar, obviously, but a lot of these others have already been breaking out. You know, we talk about technology, we talk about things like stuff that's even in ARK that has broken out, INOQ recently, right? But you're seeing it's not a topping. It's not so much like, oh my God, this thing's about to collapse and break down. It's more like, where is that, you know, where's that appreciation that you're seeing in some of these other growthy areas? Are we going to see it? Is there a catch-up trade here in ARK, you think?
I think there's got to be. I think there needs to be, right? Because like you said, they're still laggards. And you want to see the caps are working, the large caps are working, even equal weight tech. We talked about that base in RYT. Now let's go all the way down the cap scale to the junkiest stuff. Call it non-profitable tech. Call it
genomics.
Growth. Right. But I'll just point to this ARK chart towards the top, slide 18. Confluence of interest here. We got the AVWAP from the August highs, AVWAP from the December lows. So that's the basically, 52-week highs and lows there. And then we have the AVWAP from the year-to-date highs, all coming into play at the same exact level. You also have the 200-day moving average flattening out at that same level. I think this is huge. Let's get above there. We're up nicely today after pulling back big yesterday. Let's see where we close this week. But I think this is a really big level and true battleground for speculative growth.
I think they catch a bid. If we look around at what's going on everywhere else and you're seeing what they're doing, I'm not going to bet that this is going to do the opposite. So that's where I'm leaning. All right. Yeah. Semi surge. The way I learned it is that you can't really have a bull market party without the chip stocks. Semis are certainly joining the party in a big way this week. What are you seeing there? New 52-week highs, SMH.
So this is the base. We already talked about it. I mean, look, semiconductors having one of their best weeks, one of their best, string of days in a very long time here. In fact, if you look at the relative trends, if you go to the semiconductor SPY chart and look at these relative trends, whether it's semis on a relative basis or even tech on a relative basis, best single day on the NVIDIA earnings yesterday since the dot-com bubble, right? So you call that a momentum thrust, whatever you want. But when we look beneath the hood, whether it's on NVIDIA sympathy bids or on their own earnings reports, more and more of these stocks are erupting higher, and they're doing it in a very decisive way. I would really trust these breakouts if we're gapping out above the breakout level, and you're seeing a lot of that.
I mean, man, when you keep seeing these again and again and again, first of all, say what you will about, AI or whatever it is that may or may not be driving these things, but kind of taking a step back, traditionally, when you're seeing strength and relative strength in particular out of semis, is that normally a bad thing for stocks? Like, is this time different? Like, maybe, but is that the bet that we're going to make? Like, for me, these are all good things, number one. Number two, it's not just 5 stocks. We're seeing a lot of these things breaking out, resolving higher in very, very important industry groups. This isn't like lithium stocks breaking out and it's like this esoteric corner of the market. Like, this is front and center, Straza.
Listen, we were on Space yesterday, and I was saying, as a stock market bull, there's not an industry group I would rather see do this than semiconductors, right? It's incredibly bullish. And before we stop, I just got to talk about Intel here. Intel's down about 7% this week. Semiconductor index is up about 10%. Every semiconductor in the world is catching a bid. Intel is falling apart again. Go to the last 2 charts here. If you own this one, just get out. Be done with it. We don't buy stocks that, look this way on a relative.
Here's the rule of thumb. Here's the rule of thumb. For anybody willing to listen, if you own a semiconductor stock that is not making new 52-week highs, you're in the wrong semiconductor stock. Is that fair? Is that fair right there? Assessment, like rule of thumb, easy peasy.
We got a nice handful that are making new all-time highs now. Just, this one it's not what you want. Please.
All right, let's get out of America and look elsewhere.
Let's do it. All right. So talk to me about these international stocks. International equities continue to trend well as participation expands around the globe. What are some of your favorite regions outside of the U.S.?
Well, personally, I mean, I love the Mediterranean Sea and Italy and Greece. And I mean, it's just, for me, I feel so at home there. I love Japan.
Talking about charts. I'm talking about charts, not beaches.
Oh, sorry. I was going to say Japan, too, for very different reasons. Japan and the Mediterranean Sea are my favorite places on earth outside of America. Okay. And in some cases, I like those places better than America, but that's another story.
Greece and Japan are both making new highs, so you could easily segue this.
The point is, interesting, right? The places I like the most. But it's important for investors to kind of put aside their biases. Like, my love for Bronzino on the beach in Greece, should not impact my decision making on what stocks from which countries I'm going to buy. I'm going to be buying. I like leadership. And when you see Germany making new all-time highs, France making new all-time highs, Denmark making new all-time highs, a lot of industrials, by the way, in those particular areas, it's straight evidence that it is not 5 stocks, because those 5 stocks that everybody's talking about are not in any of these indexes. So let's say you're not going to buy German equities, or you're not going to buy Louis Vuitton, you're not interested in that. You're only buying US stocks. Fine. This is just evidence that there's a lot of things working, not just 5 stocks in America.
Let me just double down on your point. Go to the last slide here of IFA, right? So not only is the narrative that it's just 5 stocks that are working, it's that, it's just big cap tech dragging the US indexes higher. If you think that's a problem, and I'm kind of saying this in jest because it's not a problem, you should love that as a passive investor in SPYs or Qs. You should love that big tech exposure. That's what makes it work so good. But if you don't want that, go over to Europe, because we got new highs being made over here, and the European indexes do not have that problem. This is developed ex-North America, IFA, less than 8% technology exposure. So if you don't like that big tech exposure here in the US, go to Europe. You can still buy new highs and not have that tech exposure.
A big theme is the industrials exposure. A lot of industrial exposure in Japan. I think 23%, 27% in Denmark, 20-something percent also in France. So big time. All right, Straza. Interest rates have been on a tear the past couple of weeks. Big moves. We heading higher?
I like this chart here. Okay. I know it's very almost like a juvenile technical analysis here, right? Where I'm just looking at the number of consecutive up days in 10-year yield. If you go back to the last falling rate environment that we were in 2018, 19, early 2020, you never got more than 5 consecutive up days during that entire bear market, right? Lately, over the past few years, now we've been in a rising rate environment. You see this uptrend in the 10-year yield, consistently hitting 6 to 7 days in a row higher for yields, right? We almost just hit 8 days earlier this week, which would have been a record for this cycle. All I'm saying and all I'm trying to illustrate with this chart is simply that this type of price behavior is still indicative of a rising rate environment, right? So a lot of people are kind of, throwing in the towel on rates here and saying we're going to break down. I don't think we are. And in fact, the streak that we just had that ended this week supports that.
When you look at the former highs in 2018 at the 10-year yield, we're holding above those levels, right? 3.25. And if you look at 5-year yields, you look at 30-year yields, it's doing the exact same thing, holding above its 2018 highs. So what does that mean for energy, right? We're not seeing that bid from energy. Now, it's not breaking down, but we're not seeing that bid in energy while interest rates are hanging in there. So I'm really interested to see that. And finally, the strength that we've seen in rates and the weakness in bonds comes with the stronger dollar. And as we record today on Friday, the 26th, dollar remains strong with rising rates and stocks. What surprises me the most, or maybe what interests me the most, is the fact that how resilient stocks have been despite rising dollars and rates, which is something new.
Yeah, I agree. And look, for us, for interest rates for the past few years now, really the best supporting evidence we've had is European yields. And if you look at France, Germany, Spain, UK, their 10-year or their benchmark yields are all heading back to their cycle highs. So,
all right, what's today's phrase?
So this is a little game that we like to play. I'm going to say a word or a phrase. You're going to tell me the first thing that comes to your mind. We have PE, and I'm not talking about gym class. I'm talking about price to earnings.
I think numerator, right? I think the part that's important there is the price, right? It's price to earnings ratio, but it's the price that pays anybody, regardless of whether they have earnings or not, right? Some of the biggest winners have no earnings. So like what PE, right? If it's not, you can't have zero, right? You can't have a fraction with zero as a denominator, right? That's a thing. That's like a math thing. So for me, focus on the numerator. That's what's going to pay anybody. Like literally, that's the only thing that pays anybody. It's also the only truth, right? That E is an estimate and gets revised and all this thing. The P will never be restated. The P always remains the same. It's the only truth. CEOs could be wrong. They could be lying to you. Both happen all the time. But price is never going to be wrong. It might move in a more volatile way than perhaps you would like, but that price will never be restated. This is a buyer and a seller. It's changing shares on a given price at a given time on a specific day. It's never going to be changed.
When you say this, I can't help but think of our good old friend, Ralph Acampora, and that story of him in front of the SEC. We've been saying it as technicians for a long time, right? Focus on the P. It does not get restated. And it's a lesson from this week with the NVIDIA earnings call, right? You never want to short a stock on valuation because the estimates, that E in the price to earnings multiple, or really any estimates in any of these valuation metrics, are routinely incorrect and restated or adjusted higher, right? And that's all you saw with NVIDIA. Stock's up 25 to 30%, but on any forward revenue or earnings valuation metrics, it's actually cheaper today than it was just prior to its earnings report. So, valuations are tough and they're often wrong. So you're right, JC. Focus on that P.
Listen, no arguments from me there for sure. This is a lesson I learned the hard way, focusing on the wrong things early in my career. And it wasn't until I started focusing on price and stopped really caring about why we'll find out later. Why is NVIDIA blowing up? Because AI? Maybe. Yeah, probably. Whatever. Maybe it is. Maybe it isn't. We'll know down the road. It doesn't even matter.
So confirmation, you ready to do this 2-minute drill?
Let's do it, baby.
For me, I've been looking around at whether it's the NASDAQ, XLK, XLC. We're getting these reversal patterns. They are resolving higher. And I'm asking myself and the guys and you, what's the best confirmation we could get for these new highs? What's the best confirmation we could have for these breakouts? So let's talk about some of the things that we look for to confirm these new highs or these breakouts, right? For me, peer indexes, right? I want to see more and more of these bases resolve higher, whether it's the NASDAQ, the XLK, XLC, equal weight ETFs, subsector indexes that we talked about, with the first topic, that peer group confirmation, right? Another one would be overbought momentum readings. Keep it simple. Here in the NASDAQ 100 index, look at momentum, has just been pinned up near overbought all year, chart 53. So that's another one. And, I won't steal your thunder to go over some of the other things that we look at.
Well, we're looking at the new 52-week highs list. So I'm looking for an expansion in that list, most definitely. When you look at stocks getting overbought, you want to see an expansion of stocks getting overbought. For me, I'm looking for breadth to broaden. Can technology, can semiconductors, continue to lead? Sure. But I think you at the very least need some other sectors to start participating again. And a lot of these sectors have really just churned sideways for a lot of the year. Granted, they had big moves in the back half of last year, things like industrials and healthcare and things of that nature that just can't really get going, like technology and semis. I'm kind of looking in the peripherals. I'm looking for additional contribution outside of just growth. And I think Todd Sohn told us yesterday, I don't necessarily know that you put an expiration date on that. It can happen when it happens. I'm kind of leaning towards it probably needs to happen sooner than later. No?
Yeah, I mean, look, if you go to the percent overbought chart, I think we got a breadth thrust here in the NASDAQ 100.
Yeah.
And when you look at breadth internals for growth indexes, you are getting confirmation. The problem is you're not getting that same confirmation from value indexes. And when you mash it all together and look at something like breadth in the S&P 500, the lack of participation from these value groups is still dragging on the entire complex in a way that I don't really think you're getting that confirmation yet. So,
yeah, I'm looking outside. All right, hot takes. What do you got?
This week, all the rage has been about semiconductors, tech stocks ripping higher. It's all really good. It's all, very bullish development. I would just, direct everybody's attention to this massive unwind in defensive leadership, though, right? Because that's huge. You're literally seeing funds get pulled from the most risk-off, most defensive stocks and put into the riskiest, most offensive stocks. And I think that's incredibly bullish. It tells you that the animal spirits are alive and well when it comes to equity markets, and people are trying to move out on that risk curve. It's very much bull market price behavior. And this XLP SPY chart really does a great job of illustrating what's happened. After 3 months of consistent outperformance from defensive groups like Staples, these things are crashing, making new 52-week lows, completing a topping pattern, telling us to expect more underperformance from defensives in the future. And that is a characteristic of bull markets. So.
New 3-month highs today in consumer discretionary relative to consumer staples as well, by the way. Also, you'll see it in the high beta versus low volatility. If you go down the list of low volatility stocks, you're going to find a lot of consumer staples there. So it's an extension of what Straza was just talking about. And then just look at those former highs. This is the high beta versus low volatility. All those former highs in 2011 and 15, again at the end of 18. And we ultimately broke out after COVID and successfully retested those levels. That's not a negative looking chart. This is a bullish looking chart. And this particular ratio tends to move with the overall market.
Are you telling me that there's market memory even in relative trends? Is that what I'm seeing here?
It's just math, bro. Don't be mad at it. Don't be mad at it.
Yeah.
All right. So my hot take is the fact that I think people think too much, overthink the wine situation. Oh, am I supposed to have the white? Am I supposed to have the red? What am I supposed to do? Drink what you like, right? Drink whatever it is that you like. If you want to drink a Cabernet Sauvignon with your Bronzino and you want to be a fool, then you know what? Knock yourself out. If that's what makes you happy, then you drink that Cabernet with your Bronzino. Me, I'll be drinking an Acitico from Santorini. Like, that's how I like to roll with my Bronzino. You want to drink a Cabernet? Knock yourself out. Now, if you're having a nice like bolognese or maybe a veal parm and you want to drink a Chablis with that, I think you're an idiot. But if that's what you want to drink, you knock yourself out. You want to drink a Brunello. That's what you want to drink, right? 100% Sangiovese from Tuscany. You drink a Brunello like a gentleman with that veal parm or that bolognese, right? But if you really want the Chablis, if that's what makes you happy, you drink the Chablis. I'll judge you. But you don't need to worry about my judgment. You do what makes you happy. But if
you know what I do, JC, when I can't decide between red or white?
You ask me?
I just mix them together. I drink rosé.
Don't ever do that.
Kidding.
Don't do that. Please don't do that. We're making real rosé like the way you're supposed to make it. We're doing it with Zinfandel. That'll be real rosé. You can have it. All right, guys. Listen, thanks for watching. Make sure to give us a like and hit the subscribe button so that you never miss an update. And follow me at All Star Charts on Twitter. Make sure to follow Steve at Straza. Leave a comment below. Let us know what you think, and we'll see you next week. PTPA, pardon the price action. I like it. Good night, Canada.